Okay, so they warned us and they warned us and they warned us and they talked about it and then they did it. They dropped the bomb that is the stress test, I guess 3.0 at this point, the third iteration of a change to the stress test in the better part of 4 or 5 years right now. When is the government going to get a handle on things? It's not going to make a difference as it pertains to people qualifying, not the people that really matter anyways. Listen, if you guys haven't paid attention to the news recently or watched our Instagram or Facebook feeds, by the way, plug for Thrive Mortgage Co. or follow me as the Mortgage Pug. The government stepped in last week and announced a proposed stress test. And who's kidding? The proposed stress test is going to become a reality. It's just a matter of what will the final form look like of this stress test. Anyways, with that being said, the reality is there are a lot of different things that are impacted here and a lot of potential outcomes. And the good news is that we don't think it'll be a massive impact like it was in 2018, more of a trickle effect. Nonetheless, it's something worth talking about because it will impact people that are in the market, people that are refinancing, people that are potentially looking to invest in real estate. And hey, listen, we like to look at things through a rose-colored glasses from time to time, but we're going to be real about this and break down our thoughts in an initial review. So today's episode was our summary, first glance, first reactions of the stress test, broken all down with a chance to just really understand and break down specifically what we knew and what we know at this time right now. Now, there is time for this stress test to change. There's a question and answer period. We'll talk a little bit more about that in this episode, but just enjoy it. Do the best you can. Get educated. It's going to break down everything you need to know in a beautiful 20-minute segment. As always, guys, are you listening to this episode here today? If it's your first time, let us know. Send us a DM at Thrive Mortgage Co. again or myself. One of the things that we do is we like to thank people who leave us reviews. The reviews are so important to us. Sharing our stuff on Instagram is so important to us because it helps spread the news. We do this as a labor of love, typically at 8 o'clock or 9 o'clock at night when we're just finishing for the day. But we do have an incredible review from someone. We don't know who this is, but someone named Themcar said, A1, the best. I've been getting some great value for the podcast. It's often really hard to find good information that relates to the local lower mainland market. So it's nice to have a podcast answering most of my big questions around financing and investing. Thank you so much, Themcar. Make sure to send us a message on Instagram with a screenshot. Let us know this is you so we can send you some delicious coffee and one of those Thrive mugs. As always, guys, this show is presented to you by Thrive Mortgage Co. We are the premier mortgage finance company in the Lower Mainland. We serve all of BC and other parts of Canada. If you want to find out more about working with us, send us a DM or an email to info@thrivemortgage.ca so we can make good things happen for you. Enjoy the show. Don't get stressed out. Maybe zen out, and we'll talk to you on the other side. What's up, guys? You are listening to the YVR REMO show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. Welcome to a emergency episode of the podcast. We're going to call it that. No, it's not an emergency, but it's a breaking news episode of our show. And like always, we come to you guys with the biggest updates, the quickest timelines, and the most information that we can in a short turnaround time. So before we get too far into this, let me just give you guys a little bit of a snippet as to what we're talking about today, why we're talking about it, and realistically, like if it impacts you and why you should be listening. There were some guideline changes that were announced on April 8th of 2021 that could have some pretty big impacts on the marketplace as far as lending is concerned, purchasing, and a lot more. And so we're going to sit here today and talk for about 15 or 20 minutes about really what we know so far. There's just so many changes occurring right now in a short amount of time. So we'll cover, of course, what's happened or proposed, what the timelines and dates you need to know, who it's going to impact, and realistically, what you should do. But I'm going to take a step back and let the gentleman talk. So, Dean, why don't you just take a quick little introduction here and let us know what you know so far and maybe just your initial thoughts and feelings after getting this information.
Yeah, I mean, thoughts and feelings are, it seems a little knee-jerk in my opinion. It doesn't really seem like just after looking at the numbers and seeing the impact, if the goal here was to make this change to, help the market and slow down the market. I don't think that's the tool to do that whatsoever. Looking at the actual numbers, it's going to reduce our buying power by around 4.5%. And when you have offers, on homes going $200,000 over asking price, how is this really going to impact that? And so my first thought is this just doesn't seem like the right action.
Well, before I pass it over to Derek here to jump in really quickly, why don't we take a step back here and actually just kind of break down what's occurred, what we know, obviously, and then we could dig into, like you mentioned, really good little foresight there into some projections as to what you think is going to happen. So, Derek, maybe fill us in a little bit on what the announcement was yesterday, and just an overview as to what we should be knowing, or someone who's maybe coming into this the first time, what this is that's occurring.
Yeah, so the reasoning behind this is they're trying to slow the housing market. Obviously, as everybody knows, the housing market is absolutely insane right now, all the way across Canada. Not normal what's going on. So they're trying to implement a few regulations, and who knows what's coming down the pipe. Taxes, I mean, God only knows at this point. Yeah, but the goal here is to essentially decrease Canadians' borrowing power and buying power to slow the market down. So what the suggested, it's not firm yet, what the suggested change is there is a stress test on pretty well all Canadian mortgages, conventional mortgages, and OSFI is a regulator of all the banks, just the banks. And they have suggested that they're going to increase the stress test rate. It's currently at 4.79, and they want to increase it up to 5.25%. So a little bit on the stress test itself. It's been around for a few years now. There's been a couple different changes throughout the last few years. Essentially, a stress test is we have to qualify your mortgage at a much higher interest rate to make sure that you will actually afford and qualify for your payment if rates were to rise. So as much as people are walking out of their institution or purchasing a home at 1.5% right now, their interest rate, all mortgages are being qualified at 4.79, which is already a dramatic increase. When this was implemented a few years ago, it was about a 20% borrowing power drop. So that made a huge difference, and it actually created this massive funnel of kind of panic purchasing, right? A lot of people knew that their qualification was going to go away, their pre-approval might not be firm, and it created this mad panic up until the stress test actually came into place. And we're thinking that we might see a little bit of that again. These changes definitely do stress people out. It seems like probably a massive change, and most people that are in the market or they are pre-approved are going to freak out. Like Dean had mentioned, it's between a 4 and 5% decrease in your buying power. So it's not a massive change. I don't think this is going to have the impact that they want it to. But at the end of the day, it's just a conversation with your mortgage broker to figure out what your qualification is prior to June 1st, which is a potential date, which we'll touch on, and then afterwards.
Yeah. So the positive in this is that they have opened up this for discussion with, the key proponents of our industry to make sure this is the right move. So, think this isn't concrete. Things could change. Timelines could change. Ultimately, this may not be the change that we see. It could be even more of a drastic change for that matter. It could maybe be a little bit more relaxed. So, It is a bit of a waiting game, but we're preparing for that. This is going to take place, and these dates are firm, and we're preparing our clients for these timelines.
Yeah, so really quickly on this, so the original stress test was implemented back in 2016, and that's when there was a variety of changes that occurred, not just to how you qualify, but to how the mechanics of lending works behind the scenes, which is why today we have, quite a few different, interest rate categories for someone putting less than 20% down, or more than 20% down, or more than $1 million, or more than a 25-year amortization and so forth. And I think the reality of this is it's really, in my opinion, immediately is not addressing the issue. And to Derek's point, although it will impact some people, I've already run the numbers on some of my clients, and I can tell you it will definitely impact them. It's not going to impact, in my opinion, the right issues at hand. And the right issues that we should be dealing with are supply. There's quite simply more people and more Canadians that want to own real estate than there is supply. And we're still struggling on a day to day basis for cities to issue permits to build the proper types of buildings. And of course, if they address that actual issue, we're not in the position that we are today. Of course, now there have been conversations about everything from starting to tax your principal residence, which is obviously would be a poor idea, as well as a few of other considerations. But for the issue at hand right now, just kind of running back to what you mentioned there, Dean, 5% on $100,000, like between you and I, like that may not sound like a lot initially, but when you start to extrapolate that and say $25,000 over 500,000, I mean, there's a lot of people out there who that's their max qualification already because of the stress test, and they could actually make payments with no issue because again, the rates are 2.5% or 3% lower than that right now. And so this is definitely going to have some ripple effects. And my projection of this is that with this information coming out, the market's only going to heat up for the next 2 months. And we're not going to see a big drop off like we did back in 2019 because it's not as dramatic like you mentioned there, Derek, but it is going to heat up.
One thing I'll mention just on that is this is not for everybody purchasing a home. This is for uninsured mortgages. So if you're buying with less than 20% down, or even if you have more than 20% down, but you can qualify on a 25-year amortization and the property's worth less than $1 million. I know that sounds confusing, but there are some guidelines where you actually won't be impacted by this. If you're buying with more than 20% down and you have you need a 30-year amortization and your property is going to be worth over $1 million or your purchase price is over $1 million, those people will be impacted by this. We also don't know which lenders are going to be impacted. We know that this is directly funneled towards the banks. As of right now, most credit unions actually have a different provincial regulator, and we don't know if they're going to follow suit. They typically will eventually, but as of right now, years after the stress test was implemented, there are still no stress test programs available, right? So don't make the assumption that this is going to impact you. Inquire, ask the right questions to figure out if it's going to, and we'll make sure to keep everyone up to date on those changes.
Yeah, no doubt. So let's talk a little bit about dates here, because last time around we were given, I don't remember exactly, Derek or Dean, if you guys remember, but I think it was like a 1 month or a 2 month lag before they made the rules. And then there was a mad rush for someone to get a pre-approval, because at the time, if you had a pre-approval from a lender, you could actually close within 120 days and they would honor those rules. So we're not really sure yet if they will honor a pre-approval. I can say almost guaranteed that they will honor approvals. So again, the bank would have to have already reviewed your file and accepted it and approved it. So we can suggest that much. So that part we do know. But the other timelines I think we should be aware of are two dates, May 7th and Dean, correct me if I'm wrong here, but I think it's May 24th. So there's a questioning period starting on May 7th and then a closing period on May 24th where they're going to make their final decision and then announce the changes on June 1st. So maybe you can speak to that for a second, that process.
That's the key difference from last time, is there wasn't this question period or this comment period where we could comment as experts in the industry could comment on this. They're pretty much accepting comments from anyone in the industry on this matter. And so that's key, because this isn't final. And when the announcement was made in 2016, it was pretty much, this is what's happening. Here's the dates, get prepared. So it's really important to know that this could change. And these comments is a nice change from OSFI to actually welcome that. Secondly, the dates and like the firmness on like, okay, is it a pre-approval? Is it a purchase contract? Is it an approval? What is it that's going to actually be grandfathered? We're hoping that it's actually contracts. If contracts were written before June 1st, if that is the date, we would hope that a contract written before June 1st, even if it is closing after June 1st, would be honored. But last time around, that wasn't the case. With the foreign buyers tax as an example, that was not the case. If the contract was written, years before, such as a pre-sale, those people still had to pay foreign tax on those pre-sales, even though those contracts were written well before the foreign tax was imposed. So that's a really big one. We're really hopeful that they will honor contracts written, the date that they were written. So that's something to see. And we're hopeful that they'll honor the contract law in our country, because if they don't, gosh, pre-sales could be very risky.
Yeah, good points there. Really good points. And I think we're going to find out a lot more of the little things that we maybe didn't think of last time that are going to come up this time around. And so I just want to reiterate like who it impacts, and then we can just kind of touch on who we don't think it will impact immediately. It's been talked about already that as of right now, it's federally regulated institutions, which basically is the big banks, more or less. Credit unions last time around were a little bit slower to pick up the slack. I remember, obviously some of the bigger credit unions like Coast Capital picked it up pretty much right off the bat and decided to implement the new guideline changes. But even to this day, some of the more local credit unions do make exceptions and still don't use the traditional stress test. They might charge a higher rate. But I would imagine that most of those local credit unions are just kind of going to look at this and probably not implement this immediately. Although the bigger ones you can imagine would do this. So this is impacting you again. If you're purchasing a property over $1 million, this can impact you. And actually, interestingly enough, these are the people that are going to feel it the most, just based on the volume of the price point. Again, refinances to me is like a really, really, really key point, because I know Dean and Derek, you guys can talk this as well. Like, we've been doing a lot of refinances in the last year, and it's not just because people have a ton of debt. It's because they're trying to eliminate and start over and have, reduce their total cost. Like, it makes a lot of sense, especially given like the lower interest rates right now. It's tons of sense there. But like, again, like the other people that they're negatively impacting, we've got properties that is a consideration here, because this is an uninsured mortgage and the 30-year amortization. So yeah, we have to think about that and say, okay, well, that's actually going to negatively impact the people who are renting, because it's going to potentially reduce the supply, which means at the end of the day, there's less rental properties, which is going to cause higher rental prices. So who is this helping from that perspective?
Oh gosh, those are such good points, especially on the refinance side. Like, people are realizing huge amounts of equity because of this crazy market. We have clients that purchased townhomes in early 2020 that with less than 5% down, that now could potentially refinance into a conventional product, and that this will potentially impact those people, likely will impact those people. So when we talked earlier in the show that the impact on the market isn't going to be much from this change, but the impact to Alex's point on the actual borrowers is huge. And like, refinances is the one that sticks out most for me. And it's unfortunate, but they will feel it for sure.
Yeah, for sure. And I mean, on a bit of a positive note, just to, talk about the importance of working with a mortgage broker to understand your options. A lot of times we actually do have certain institutions that can bend and kind of extend debt servicing. Typically, most lenders can use 39% of your income to cover the housing costs, which is mortgage payments and property taxes and strata fees. We have examples where we have lenders that will go up to 46, maybe 47% if it's a strong application. So just knowing your options, knowing that there are different, solutions out there is really important when you go into this, because one bank might say no and the other might say yes.
Yeah. That's such a good point. Such a good point, Derek. I was on a phone call this morning with someone and immediately right away recognized that although they would be impacted by this change, we were able to qualify them for substantially more than what they were advised, just based on someone not understanding the guidelines that are available to you. So definitely happy to put the plug in from that standpoint. So why don't we just kind of pushing forward a little bit deeper into this right here. We've talked a little bit about what the borrowing power difference is, what that might impact, and of course, who that might impact and so forth. But like, just kind of future dating again, looking at the dates, looking at the timelines that can affect. What are you guys thinking that we're going to see here as far as market conditions over the next? I know this is new. We've already talked about this last night this morning, but hey, initial thoughts. Like, what are you guys predicting? Any thoughts or ideas?
Well, to your point earlier, approvals will be honored. So like an approval that was approved prior to June 1st, those should be honored. We'd be shocked if those aren't. So people are going to be rushing to get their approvals in. People that were sitting on the fence and maybe thinking of buying in the late summer are likely going to be buying before June 1st now. So we're going to see an extreme amount of pressure in the market from now until middle of May, I would say, to rush to get these approvals in. And on that approval subject, lenders are already significantly delayed with volume. So we're going to see extreme delays. I'm not going to name lenders, but there's a number of lenders that won't even look at a file for 4 weeks right now. And so we're going to see more of that. And so like waiting till, these deadlines are confirmed, I wouldn't wait. If your goal is to purchase a home, I would get in now and move this forward and get that approval in place as soon as possible. So I just see extreme pressure coming.
Yeah, and we're already kind of seeing a bit of a slowdown in the detached market. There was a massive boom over the last 3 to 6 months, and it seems like it's kind of toppling off. There's still multiple offers, but there's maybe 2 or 3 offers instead of 30. But it seems like the strata market is really going crazy, and this might even drive the strata market even further. You know, if someone's qualification has actually been pushed away, where they were just barely qualifying for detached and they can't find another option, they might be more keen to move into the strata market, which could cause that to boom even further than it is.
Yeah, really, really, really solid points about obviously the strata market being impacted again. I think that obviously just based on what you mentioned, Dean, with a slight slowdown in the detached market, in my opinion, this is going to put a little bit more fuel back on that fire for the better part of the next 60 days. And if you're selling detached, we've already talked about before, like sell that detached home now, because again, the fuel is back on the fire. Whether or not it impacts people, you got to remember, we're going to give you guys the straight goods and information. There's a lot of bankers and people out there who do not understand this policy, and they're going to push you to make a decision. So this might not even impact you. So keep that in mind before you obviously sell or buy or do what you decide to do, to make sure it does or doesn't impact you. So yeah, detached housing market has slowed down a little bit. I think this brings it right back for at least the next 2 months. And again, probably no big dips or anything after that, but maybe a little bit of a flat line with some fatigue. Derek, man, I couldn't agree more. The condo, attached market is certainly going to see a little bit of a change. What I'm curious to know is what do our investor clients decide to do here, and what are the changes that occur from that standpoint? Does this impact people and want them to get into the rental market because it's going to impact their ability to spend more money on a rental or not? I think initially, as an investor, you want to be prepared, but you don't necessarily want to just dive in without having the information. That being said, know your numbers, know your qualification, know what this will impact. But I think this is actually, although not a big change, this will, in the long run, work well from an investment standpoint for rent. It just kind of is what it is as far as that's concerned. That being said, biggest feedback for anybody listening to this or watching this, whether it's on the podcast or live on the video, there is number one, longer wait times. Dean, you mentioned it. You're going to be dealing with longer wait times. Honestly, like even us at this point, like the volumes of even just straight up questions and requests is insane. Additionally speaking, your lenders, like, yesterday, even one of our top lenders, I was having a conversation, we're one of the highest funders with one of these banks in the country. And even they told us, like, hey, even though we're in a priority sequencing, they're still, 4 to 6 days behind. Right, which is not normal. They're usually 1 to 2 day turnaround timelines. So you be prepared for longer wait times. And what does that mean if you're purchasing a home? Is that either you have to get a little bit longer subjects, or you got to make sure to do that due diligence up front. And there's a little bit of a risk to be had there. I mean, we're human, right? You can do what you can do. So listen, if you guys are, again, watching, enjoying, and listening to this kind of content, make sure to leave us a like on Facebook, Instagram. Give us a rating on the podcast. If you don't know where the link is, let's get it over to you. Thanks so much for tuning in today for this episode, and we'll continue to give you more information as it comes. Any last parting words there, Dean or Derek?
Yeah, just final comments for me and we talked about this is not impacting business for self clients that are looking for alternative lending solutions. This is not impacting you. So just be mindful of that. I've had a few calls from our self-employed clients that are really worried, and there's no impact.
Yeah, I think that's actually, thank you. We should have talked about that for a while. We'll have to do a separate episode just on that piece. Really, really, really good point to be had. Does not impact you in the alternate lending space right now.
Yeah, and we'll keep this up. We'll keep you guys up to date. There are going to be more announcements through May, so we'll jump on here again and go from there.
Adios. Talk soon.